Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the world of automated trading on MetaTrader 5. In today's lesson, we're taking a close look at an expert advisor called Deviation-Scaled Trend Cross. This strategy is built around a fascinating adaptive indicator from John Ehlers, the Deviation-Scaled Moving Average, and it uses that line as a smart baseline for timing pullback entries within a trend. By the end of this video, you'll understand how the indicator is built, how the entry and exit rules work, and how it all comes together on a live chart. Let's get started. So what exactly is the Deviation-Scaled Trend Cross, and who might find it interesting from a learning perspective? At its core, this is a trend-following pullback strategy for the MetaTrader 5 platform. Rather than relying on a standard moving average like an EMA or a simple comma, it uses John Ehlers' Deviation-Scaled Moving Average, often shortened to DSMA. This is an adaptive baseline that speeds up when momentum is statistically meaningful and slows down when the market is just drifting sideways. Because it's built on a single indicator applied to one time frame, the logic is refreshingly transparent. The DSMA gives the strategy a clean, responsive line to work with. When that line is sloping firmly in one direction, the strategy treats the market as trending and looks to join that trend on a pullback, rather than buying breakouts at extended prices or trying to pick tops and bottoms. The strategy trades both directions with distinct long and short rules, and it can be applied to any symbol and time frame you attach it to, whether that's a major currency pair, an index, or a metal. It's designed to trade one position at a time, keeping the behavior simple and easy to follow. From an educational standpoint, this EA is a great example for traders who want to understand adaptive filters and how a trend regime can be defined mathematically using slope and volatility rather than by eye. It shows how a pullback entry can be structured objectively, and how ATR can be used to size both the stop loss and the take profit so that risk scales naturally with market volatility. As always, none of this is a promise of results. It's a framework for learning how a rules-based system thinks. Let's now open up the mechanics and see precisely how each decision is made. Let's break down exactly how the Deviation-Scaled Trend Cross approaches the market, step by step. Everything is calculated on closed bars of a single time frame, so the strategy acts once per completed candle and never reacts to a half-formed bar. The foundation is the Deviation-Scaled Moving Average. It starts with a simple momentum series that Ehlers calls zeros, which is just the current close minus the close from 2 bars ago. That raw momentum is noisy, so the strategy passes it through Ehlers' 2-pole SuperSmoother, a low-pass filter that strips out the jitter while keeping the meaningful swings. Next, the strategy measures the root mean square of that smooth series over the chosen length, which by default is 20 bars. This root mean square is a running measure of deviation, and dividing the smooth momentum by it expresses the move in standard deviation units. That normalized value is what the code calls the scaled filter. Here's the clever part. The smoothing constant, alpha, is set to the absolute value of that scaled momentum multiplied by the gain input and divided by the length. When recent momentum is statistically large, alpha grows, and the moving average accelerates onto the move. When the market drifts in noise, alpha shrinks and the line idles, almost flat. The result is a baseline that reacts quickly in a genuine trend, yet stays calm in chop. Now the trade rules. First comes a regime gate. The strategy measures the slope of the DSMA over the slope loopback period, 3 bars by default, and divides it by the ATR, so the slope is expressed in volatility units. If that normalized slope rises above the SlopeAtrMult threshold, the market is treated as an up regime and only long setups are considered. If it falls below the negative threshold, it's a down regime and only shorts are considered. Then comes the entry, a pullback-reclaim. In an up regime, the strategy waits for price to pull back to the DSMA and then close back above it, while the scaled momentum is positive. That combination signals a long. In a down regime, price rallies back to the DSMA and then closes below it, with negative momentum, signaling a short. Finally, risk management. Every position is given an ATR-based stop loss and take profit. The stop sits at 2 times ATR by default, and the target at 3 times ATR, a reward to risk of 1.5 to 1. A position is also closed early if price crosses back through the DSMA against it. Let's read through the core of the MetaQuotes language code. just as you'd see it in MetaEditor. At the top are the inputs. Length sets the DSMA window and defaults to 20. Gain, defaulting to 5, controls how strongly momentum drives the adaptive smoothing. Slope loopback and slope ATR multiple define the trend regime gate. ATR period sets the ATR used for both the slope normalization and the stops. Stop ATR multiple and TP ATR multiple, at 2 and 3, size the stop loss and take profit, and lots fixes the trade size. Just below, the strategy computes two booleans for the regime. Regime up is true when the ATR-normalized slope is above the positive threshold, and regime down when it's below the -1. Then cross up and cross down detect the reclaim. Cross up is true when the previous close was at or below the DSMA and the current close is back above it, and cross down is the mirror image. Look at the long block. The long signal is only true when the regime is up, a fresh cross up has occurred, and the scaled filter, our normalized momentum, is positive. When all three agree, the code reads the ask price, places the stop loss one stop distance below it and the take profit one target distance above it, and calls trade.buy with those levels. The short block is the exact mirror. The short signal needs a down regime, a cross down, and negative momentum. When those line up, the code reads the bid price, sets the stop loss above entry and the take profit below it, and calls trade.sell. Notice both distances come from the same ATR value, so the stops automatically widen in volatile conditions and tighten in quiet ones. That's the whole engine in a nutshell. Now let's bring the whole strategy to life on this illustrative chart. On the price panel, you can see our candles along with the blue line, which is the deviation-scaled moving average, the adaptive baseline at the heart of this strategy. Below the price is a second panel showing the scaled momentum, the normalized value that must agree with each trade. Watch how the blue line and that momentum reading work together. Look at the opening candles on the left. Price is stair-stepping higher, one green candle after another, and the blue DSMA line is sloping steadily upward beneath the price. In the lower panel, the momentum reading is comfortably positive. Because the ATR-normalized slope of the DSMA is above the threshold, the strategy has classified this as an up regime, so it's only looking for long setups here. It is not chasing the rally, though. It waits patiently for a pullback. That pullback arrives next. Price stalls and eases back, and one candle actually closes below the blue line, while the momentum reading cools back toward zero. This is exactly the condition the strategy is waiting for. Price has dipped beneath the baseline inside an established uptrend, coiling for the next move. Nothing is done yet, because the reclaim has not been confirmed. Then comes the reclaim candle. Price snaps back and closes decisively above the DSMA. The momentum reading turns back up and is clearly positive, and the up regime is still intact. All three conditions agree, and the buy entry marker prints right there. This is the pullback-reclaim long, by the dip back through the adaptive baseline in the direction of the trend. The moment the trade opens, the strategy places its stop loss below entry at 2 times ATR and its take profit above at 3 times ATR, that 1.5 to 1 reward to risk we discussed. From there, price does exactly what the strategy hoped. The next candles push higher, riding above the rising blue line, and price reaches the take profit target marker, closing the long trade at its target. Notice the DSMA followed the whole advance from below, acting like a trailing baseline the entire way up. Now the character of the market changes. After that peak, price rolls over. A sharp bearish candle drops back to the blue line, and the DSMA flattens and begins to slope downward. Within a few bars, the ATR-normalized slope crosses below the negative threshold, and the strategy flips into a down regime. Now it's only looking for shorts. Watch the mirror image play out. Price makes a weak rally back up to the underside of the falling DSMA, one candle closing right at the line. That's the rally into the baseline. Then the very next candle breaks down and closes back below the DSMA, while the lower panel shows momentum now clearly negative. Down regime, a downside reclaim, and negative momentum all agree, so the sell entry marker prints. This is the short version of the same idea. Sell the failed rally back through the baseline in the direction of the trend. Just as before, the stop loss is set above entry and the take profit below, both sized from ATR. Price then slides lower, candle after candle staying under the declining blue line until it reaches the take-profit target marker and the short is closed. 2 trades, one long and one short, both following the same simple rhythm. Identify the regime from the slope of the adaptive line. Wait for price to pull back to that line, and enter on the reclaim in the trend's direction, with momentum confirming and ATR defining the risk. And that brings us to the end of our deep dive into the Deviation-Scaled Trend Cross Expert Advisor. Today you learned how Ehlers' Deviation-Scaled Moving Average is built from smooth, volatility-normalized momentum, how its slope defines the trading regime, and how the strategy times pullback reclaims of that adaptive baseline for both long and short trades, always with an ATR-based stop-loss and take-profit. Remember, everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. All trading involves risk, and losses do occur. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like me to analyze next, and subscribe for more MT5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.